What's up, everybody? This is Sunko, the Korean bro. Today is 2024, March 7th. And tonight I'm going to read articles again, okay? Okay, first things first. Let me read this article and see what stocks are better than Nvidia, okay? Okay, the artificial intelligence stock could double and it is way cheaper than Nvidia. And what are they exactly? Technology stocks had a good start in 2024 with the Nasdaq 100 technology sector index gaining more than 10% already. And artificial intelligence has been the driving force behind this rally. Strong quarterly results from a top AI name such as Nvidia lifted not only tech stocks but also the market as a whole, with both the Nasdaq and the S&P 500 indexes hitting new highs. The positive stock market sentiment seems to have rubbed off on internet browser provider Opera as well. Shares of the company shot up more than 15% on March 1st as investors reacted positively to its fourth quarter 2023 earnings report. Let's see why the market gave the thumbs up to Opera's results and check why it could be an ideal alternative for investors looking to buy an AI stock that's not as expensive as Nvidia. So, okay, I get it. So, Opera is one stock that author strongly recommends. Okay, I get it. Opera beats expectations and predicts another good year. Opera's first quarter revenue increases 17% year over year to $113 million, leading at the higher end of its guidance range and exceeding the consensus estimate of $112.2 million by a whisker. The company's adjusted earnings per share shot up to $1.38 from $0.22 in the year ago period. Opera credited its growth to the increased traction of its ad business, which grew 20% year over year. Advertising now accounts for 60% of the company's total revenue. Mm. Consistently strong revenue growth is expected to lead to robust improvement in the company's bottom line as well. Mm. I get it, but to be honest, my opinion is that I don't see any difference between Opera and other web browser because I don't see many people using Opera, whereas I see many people using Google, ChatGPT, and stuff like that. You know, so I don't see the point in this article that it has much more potential than Nvidia. Mm. So I'll just skip it. Okay. Super microcomputer stock is rising again today. Is it still a good buy? So there's been a recent hype with this company named Super Microcomputer. Unfortunately, I didn't gain an opportunity to buy this stock, but I know there's been hype going on with this stock. So at least I have to know what this is, right? For all I know, this has something to do with a server rack, and a data center. Uh, a lot of a server rack should be needed, right? So in that perspective, I think this has gone up so much high recently. It has gone up by 500% or more in the past 2 years. Hmm. Anyway, let's read this article and see what this author says, okay? The momentum driving supermarket computer sharp rise is continuing on Wednesday. Supermarket shares rose as much as 7% in morning trading and were still about 4% higher by mid afternoon. Those gains came in the wake of an earnings report from a cybersecurity leader, CrowdStrike, that impressed Wall Street and strengthened the notion The demand for computing power is continuing to increase. The stock has delivered a remarkable 300% jump year to date, and Supermicro and its insiders are taking advantage. Other investors may want to do the same. Capitalizing on the SMCI stock jump, Supermicro stock has been moving higher for a good reason. Its artificial intelligence server products are in high demand as AI technologies transform how business operate. Sales more than doubled year over year in the most recently reported quarter. The company sees that growth continuing. Much of the anticipated growth is already priced into the stock, though. Even if the forward price earnings ratio is over 50, so growth will have to exceed estimates for some time to bring the stock's valuation more in line with historical market levels. That may help explain why the company and some of its executives are making moves to take advantage of the stock's rise. On February 27, Supermarket announced it had raised about $1.7 billion from the sale of convertible senior notes. That was a smart move as the company was able to find a buyer of the bonds at a zero interest rate. Making moves to take advantage of the stock's rise. Supermarket announced they had raised about $1.7 billion from the sale of convertible senior notes. That was a smart move as the company was able to find a buyer of the bonds at a zero interest rate. Another company filing from last week showed that one company director sold some shares. Director Daniel Fairfax has sold more than 1,200 shares over the last year. Over the past year, there have been 29 insider stock sales, but only 4 insider buys. Insiders sell shares for many reasons, including personal ones. So these moves shouldn't raise any alarms for investors. But given that its current share price already factors in a meaningful amount of hope for future growth, retail investors who have supermarket shares in their portfolio should also think about taking profits by selling at least a portion of them. Ah, not much information is stated here. Uh, Okay, what I'm going to do now is look at trend of S&P 500 and Nasdaq 100. Um, I selected 50 out of 500 S&P 500 and see its recent change. Tesla uh, is by far the one that has gone down the biggest out of the 50 ones that I chose from 500. And now we have S&P 500 here. Also here we have Tesla as the one that has gone down uh, the biggest. It has gone down by 41% um, in the past year. Mm. And see, let's see if it's still viable. Um, I mean, now that it has went down by 41%, some would say, it's gonna go down more and more. So I'm not gonna buy it. I'm going to buy it when it hits bottom low. But nobody knows uh the bottom of Tesla. Because I mean, even God doesn't know where the bottom is. So the thing that I have to do is look for chances uh, when it's going down, because um, I mean, long term, it's gonna go up anyway because Tesla has got so much potential. Um, okay. Anyway, let's read an article about Tesla again and analyze things um, analyze reasons why I have to buy it. Okay. Okay, Magnificent Seven AI plays a losing interest. Tesla quotes Australia auto lobby over claims and car emission standards. Tesla is no longer one of the top 10 most valuable S&P 500 companies. Mm, why Tesla and consumer habits are squeezing out EV charging stocks. Okay, electric vehicle owners are looking for somewhere to plug in their EVs, right? And investors looking for the next hot EV stocks are mulling whether EV charging and infrastructure companies are worth the cash. But fundamental changes in how consumers charge EVs and the continued uh, dominance of Tesla Motors are set to leave EV charging stocks out in the cold. With automakers still driving forward with a production of electric vehicles and hybrids, a small battery of companies has sprung up hoping to address America's charging needs. Among the publicly traded companies specializing in creating charging infrastructure for electric vehicles, these companies are getting a chilly reception from the market. Boeing shares are struggling to rebound but remain near its 42-week low hit in January. Its rival ChargePoint has tumbled from all-time highs in 2020, with shares hitting their lowest levels in January. Why EV chargers aren't like gas stations? Okay. So EV charging companies aim to create a charging network modeled after the reach and coverage of gas stations. But 80% of EV charging is done at home, with users citing convenience and the low cost of residential charging, according to research from the US Department of Energy. EV owners don't charge vehicles at centralized recharging point in the same way combustion engine-driven cars fill up at gas stations. Experts say the ability to charge an electric vehicle at home is a fundamental shift in the way we're dealing with our vehicles. Uh, Nizag is the manager of automotive testing and insight at Consumer Reports. You can't fill up your gas-powered car at home. With EVs, not only is that a new thing, it's a major convenience of having an EV. While Tesla's charging network dominates in size, Tesla's moves on the EV charging front have all spelled trouble for EV charging stocks. The automaker began building out its supercharged network in 2012, the year the company rolled out its first Model S. Tesla's focus on charging stations has paid off. The company now has the largest EV charging network in the US. A Bloomberg report found that as of 2023, Tesla has a bigger charging network than all of its rivals combined. Wow. Wow, that's a good thing. I mean, okay, I get it. So here's the point. Tesla has a bigger charging network than all of its rivals combined. Okay. That first mover advantage paid the dividends when Tesla charging plugs saw widespread adoption from rival automakers. In May 2023, Ford announced a deal to use Tesla charging stations, closely followed by GM, other rival automakers. The move culminated in Tesla charging plug becoming the North American charging standard, the de facto US standard. Okay, the move culminated in Tesla's charging plug becoming the North American charging standard, the de facto US standard. With a market cap of $645 billion, Tesla is certainly far more valuable than its EV charging rivals. But the company's share have continued to oscillate, oscillate within a 150-point range over the last year. The stock showed signs of consolidation from February until June last year, but since then it has continued to hover around the upper range of its consolidation. Tesla's vertical wait, see. Okay, Tesla's charging network dominate in size. What is the point? It's way bigger than its rivals combined. Okay. Tesla's vertical integration pays off. At the expense of EV charging stacks, Tesla's focus on seamless experience for owners of its EVs has also created a halo effect around its superchargers. No doubt Tesla's supercharging network is the most reliable, and I can anecdotally say that's true even for myself. Zach said. He attributes the Tesla supercharger's reputation to the company's vertical integration, producing cars and chargers that work seamlessly together. No doubt Tesla's supercharging network is the most reliable, and I can anecdotally say that's true even for myself. He attributes Tesla's supercharger's reputation to the company's vertical integration, producing cars and chargers that work seamlessly together. You pretty much know your experience is going to be pretty consistent, regardless of which one you go to in the car, he said. You pretty much know your experience is going to be exactly. So Tesla dominates in size. People experience Tesla and they automatically think Tesla is the option they would choose because they are comfortable using it. It's everywhere, dominate in size, and people automatically think, oh, it's everywhere because it's good. Mm. Nizek emphasized a phenomenon called charging anxiety when it comes to public infrastructure charging stations. He said many consumers find themselves asking, what's the charging situation is going to be like when I show up? Is the charging functioning? Well, will there be a line? Is it going to be fast? Consumer reports find that worries about the charging experience or fast replacing range anxiety is number one problem among new EV owners. Worries about the charging experience or fast replacing range anxiety as number one problem among new EV owners. Okay, so people worry when they charge their car. Worries about the charging experience. Okay. Range anxiety is a concern over whether an EV charging location is available when a charge is needed. Gas for EV charging stocks to thrive. Despite Tesla's dominance and evolving habits of EV owners, EV charging stocks can still keep a toehold in the US market. Experts say the most obvious ways for EV charging companies to help build out their network of public chargers. Okay, experts say the most obvious way is for EV charging companies to help build out the network of public chargers. Gaps for EV charging stocks to thrive. Most obvious way is for EV charging companies to help build out the network of public chargers. Toehold. We need to put high-speed charging every 50 miles off the highway in the US. Pierce is senior equity research analyst at Needham Company. The adoption is never going to happen unless you can get in your car at a moment's notice and not worry about charging. Even a company as dominant as Tesla can't put a charger in every shop, corner, and opening up a market opportunity for other EV charging stacks. Smaller EV charging companies can survive by focusing on rounding out nationwide EV infrastructure coverage and by pursuing deals to charge fleet vehicles. Beyond the private EV owners, Pierce also pointed to the gap in demand beyond the private EV owners. In the commercial market, Well, there's a huge demand for charging stations that could serve school buses, municipal services, and fleet vehicles. People don't take the cars home with them. They drive their car to sleep at a lot and take their personal vehicle out on the road, he said. That truck needs to charge overnight somewhere. EV charging infrastructure can also become a workplace, a retailer amenity, in turn providing charging companies with throes of user data, says Pierce. Besides Boeing's success in setting up chargers at auto dealerships, post offices, and with fleet vehicles, Boeing's advantages. In fact, among EV charging players, Boeing enjoys important competitive advantages. Pierce also says, unlike its competitors, has industry-leading margins, which can combine with a niche play to put the EV infrastructure provider in a secure market position, even if it's forced to operate on the periphery of major incumbents like Tesla. Okay, not much information is here, but what I gain is that Tesla dominates Tesla's, you know, what is it? Tesla charging dominates in size and it's bigger than its rivals combined. Okay. That's really important because people experience and people automatically think Tesla is the best, right? Okay, let's see this one. Okay, the automobile market is going through some of a renaissance right now. Car manufacturers worldwide are investing significant sums into battery-powered vehicles, perhaps the bedrock of the green energy movement. Moreover, the notion of self-driving cars has become increasingly more prominent among car manufacturers and tech companies alike. General Motors has been trying to make inroads in self-driving technology for years. Most notably, the company acquired a majority stake in a startup called Cruise back in 2016. However, over the years, Cruise has been plagued with operational setbacks. Most recently, several public reports suggest that Cruise's evaluation has been lowered by more than half. Debate goal, okay. Driving on cruise control. Cruise is just one of many companies exploring autonomous driving technology. Alphabet has been exploring self-driving for years through its subsidiary Waymo. Moreover, Tesla has long been considered the leader when it comes to self-driving vehicles. In fact, famed mutual fund investors Ron Baron has gone as far as say the supercomputer capability behind Tesla's autonomous driving unit called Dojo could be a $1 trillion business itself. It's no wonder other investors, including Honda and Microsoft, have helped pour billions into Cruise. But while self-driving prospects are both intriguing and lucrative, Cruise has been no stranger to controversy. More recently, toward the end of 2023, Cruise hit several bumps in the road. The company was forced to suspend operation in California following a collision between one of its robotaxis and a pedestrian. Shortly thereafter, the company halted operations in other markets across the U.S. Okay, last but not least, let's keep and read this article. Okay, here's why Tesla could emerge as a big winner. Reported valuation drop in Cruise shouldn't inspire confidence for General Motors investors. While General Motors presents an interesting alternative to other electrical vehicle and self-driving car opportunities, I think the company is rapidly falling behind in both areas. It seems General Motors miscalculated the sophistication of autonomous driving and tried to buy its way into the market. By contrast, Tesla spent years reinvesting cash flow into business as it remained steadfast in developing the most thorough automobile technology on the market. While the timeline for Tesla's commercialized self-driving technology remains somewhat of an enigma, the company's CEO Elon Musk has teased that it could be here sooner than people think. While management deserves some credit for identifying emerging growth areas, the problems that Cruise are exposing General Motors is just another car company with little real innovative edge. On the other hand, Tesla has proven it can develop industry-leading technology the consumer actually want. Although Tesla is still very much a car company today, I'm bullish that it will evolve into more prolific technology operation in the coming years. As such, even though General Motors isn't giving up on self-driving entirely, I think investors are much better off as buyers of Tesla stock at this moment. The recent whoosh Cruise are just another setback for an already beat up operation. I wouldn't be surprised to see more challenges ensue for General Motors. In the long run, should Tesla succeed in self-driving ambitions, the company will have an enormous opportunity to license its software to other car companies, similar to what it is already doing with its supercharger network. For this reason, I see Tesla emerging as the ultimate winner in the autonomous driving race. I think the company has a multi-billion-dollar opportunity in the palm of its hand. Okay, interesting news about Kathy Wood. Kathy Wood buys hmm, so many Tesla stocks. Uh, okay, uh, this article is going to be my last article, and let's read this one, and then I'll finish YouTube live. Okay. This one is about Tesla as well, and let's see. Okay. Hmm. Big tech many have just found newest shiny object humanoid robots. There's been recent hype with humanoid robots for sure, and it's all over. I mean, on SNS, I mean, people see it. Humanoid robot moves and do laundry and do kind of like home chores. You know, okay, let's see. Humanoid robotics are all the rage, but on the surface, humanoid robots might seem like some out of science fiction novel or a dystopian Hollywood thriller. But believe it or not, the market for humanoid robots is much bigger than you might think. Okay, its market is so big. Okay, I get it. While widespread commercialization of humanoid robotics is still likely years away, investors can get a glimpse into the impact this technology can have by looking at two of the world's leading e-commerce business, Amazon and Alibaba. Both companies have made significant investment in robotics, namely integrating the technology throughout warehouse operations. This allowed each company to achieve significant efficiencies as it relates to its logistics and order fulfillment. So, okay, humanoid robot has been used broadly in Amazon and Alibaba. Amazon and Alibaba, they got their own warehouses, so they have to use humanoids to make production efficiently, right? So they had no choice but to do some investments on humanoid robots, right? Okay, when it comes to humanoid robots, specifically, this is an OpenAI's first foray in the space. A year ago, the company joined the famed venture capital firm Tiger Global when it backed one time a Norwegian startup developing human-like androids. More recently, one time announced an additional $100 million of funding in January. The deal with Figure AI is just another start line showing that there is a big interest in this area of robotics. Furthermore, given the number of artificial intelligence business fueling these investments, it's fair to think that robotics could present a lucrative source of growth beyond current AI applications. However, while it's exciting to see so many companies show interest in humanoid bots, keep in mind that this technology isn't exactly new. Okay, now here we have Tesla. Tesla has been developing technology for years. Okay, so you're probably familiar with Tesla for two reasons. First, the company CEO Elon Musk is in the headlines on a daily basis. Second, the company's electric vehicles are a sensation. What you may not be so familiar with is Tesla's adventures outside of automobiles. The company has some interesting projects covering self-driving as well as robotics. Tesla's humanoid robot called Optimus is widely considered to be one of the company's biggest future growth drivers. The company's long-term vision is to integrate these bots into Tesla's factories to help upgrade vehicle production. In theory, this can unlock efficiency as it relates to labor cost. Okay, so I get it. So Amazon and Alibaba, they both were able to have great advancements on humanoid robots because they had to use robots in their warehouses. Likewise, Tesla has been focusing on humanoid robots because they could use it in their own warehouse, which is a factory of vehicles. Okay, the company's long-term vision is to integrate these boats into Tesla's factories to help upgrade vehicle production. In theory, this can unlock efficiencies as relates to labor costs, much like what Amazon and Alibaba have done in their warehouses. Moreover, Tesla has also plans to commercialize Optimus for consumers as the bot is being designed to help automate daily activities, including laundry, among other mundane tasks. So, who will win the robotics market? Following the fundraise, Figure AI's co-founder Brett Adrock posted the following on X. Musk replied with a curt counterpoint. Well, this is pretty typical trolling behavior from Musk. It makes you wonder what each company may possess to spur your long-term gains. Okay, so Figure AI is one of the competitors of Tesla, and who never knows? We never know who's going to be winner at the end. Hmm. But I assume the Figure AI also has some points they can compete against Tesla. Okay, Tesla has $29 billion of cash on its balance sheet, and the company is consistently generating positive free cash flow, which can use to further invest in growth areas such as robotics. The addressable market for human robots is at least $42 trillion, largely driven by the market for manual labor. When you layer consumer household application on top of this, the serviceable market is even higher. So there will probably be more than one winner in the humanoid robot market. But to me, Tesla still emerges as the biggest winner. Tesla sees success with Optimus. It's very possible that the company being licensed this technology breakthrough, much like what it is doing with its supercharger network. Okay, supercharger network. He also admits the supercharger network, Tesla supercharger network dominates in size. So people like in the US have no choice but to use Tesla, and even Tesla supercharger network has become like a standard. So every other supercharger network companies uh, have to change their system or whatever to uh, to gain customers. Well, the subtle theme with Optimus is that it represents both a way for Tesla to diversify its revenue stream, all while bolstering its existing cash flow, the car business. So while I find the Figure AI deal interesting and encouraging, ultimately I see the fundraising as further validation of Optimus, if anything. Okay, this is it for today. Tonight, what I tried to do was to gain new information about Tesla, and I think that's enough. See you and have a good night, everybody. Bye bye. Bye bye.